Well, there's an awful lot of market expectation building up around the Federal Reserve's annual Jackson Hole Conference, a hope that something will be announced to restore confidence in the US economy. Well, let's cross to London now, where I'm joined by Jan Randolph, Head of Sovereign Risk at IHS Global Insight. Jan, welcome to the programme.
Hi, pleased to be with you.
Well, the multi-billion-dollar question, what will Ben Bernanke do?
Well, yeah, I mean, there's gridlock, policy gridlock in Congress over the fiscal positions, and everyone's looking at the Fed to see what it can come up with to support weakening growth in the US. This time last year, the US Fed came up with quantitative easing Mark II to boost the economy. What we saw was an increase in stock prices and other risk assets, and they're looking for possibly a QE3, another round of that. But it's very unlikely. Even Ben Bernanke has doubts about the power of another round of quantitative easing, basically buying more and more securities, including treasuries, on the balance sheet of the US Fed. But I think what the Fed will do, it will probably swap longer-term treasuries for shorter-term treasuries. That will lower longer-term yields and interest rates, and it will help US households, because US households' interest rates are linked to the long end of the yield curve. So we'll get a bit more support to housing, I think.
But there won't be the big announcement, because a few weeks ago the Fed said that it was going to put interest rates or keep interest rates at zero for a couple of years. Now, if there's further stimulus, presumably that would put significant additional pressure on inflation as well, and that's something else he's got to juggle with.
Well, inflation's a little bit higher than last year, and that was one of the main intentions. Yes, certainly on the short end, yields are going to be kept virtually zero for 2 years. But now he's looking at the longer yield end, and that's where mortgages in the US are linked to, and that will help a little bit of refinancing, lowering the debt service costs of these stressed-out US households.
If you're right, will that be enough to convince markets that we are on the road to recovery in the US?
Well, I think it'll be helpful. I think what Ben Bernanke has to think about is not quantitative easing, but qualitative easing. Hold the hands of investors and say, hey, look, half the problem here is a lack of confidence. What you need to do is go out and invest a bit more. I mean, it's not that bad out there. We're not quite in a recession yet. There are still a few positive indicators there. But, the recovery since the financial crisis was always going to be one that moves and fits and starts. And we're in a soft patch at the moment, but not off a cliff.
What sort of impact do you think Friday's announcements will have on Europe? Because it's a very fragile situation over there. And I see today, overnight, Germany, overnight our time, Germany actually criticising the European Central Bank for all its buying of Italian and Spanish bonds exceeding their mandate.
Yeah, very, very interesting developments here. We've got the two most powerful institutions in Europe, the Berlin government on the one hand, and nothing gets done in Europe without the German signature now, but also the ECB. The ECB 2 weeks ago threw out its Bundesbank German-inspired rulebook and weighed into the Spanish and Italian bond markets, buying them up, bringing down those borrowing costs, but only on condition, strict condition, that Madrid and Rome would start to engage in a new round of fiscal austerity and also structural reforms. That was the key condition. But the Germans have been very much against the idea of mixing fiscal policy with monetary policy. It's been their long tradition. They've always had a very independent Bundesbank that was separate from government. And they wanted the ECB to behave like that. But now, because of the crisis situation, it's throwing out the rule book, at least temporarily. And
presumably that also impacts the amount of money that countries like Germany are putting into the pot.
Yeah, I mean, what we have is really a risk-burden sharing game going on between Berlin and the ECB. Who is carrying the risk can here in terms of refinancing Greece and potentially supporting others like Spain and Rome? The Germans would prefer that that this would be not just the ECB's role, but also the Eurozone governments. But there's a bit of to and froing here who ultimately carries the can. In countries like the UK and the US, there's no problem with the central bank quantitative easing, buying up assets, including government bonds. But there's a real problem of doing this in Europe. Germany really doesn't like the idea of a central bank buying up government bonds. For them, that's the road to ruin.
Yeah. All right. Well, it would be very pleasant, Jackson Hole, if it weren't for the need to save the world. But Jan Randolph, thank you very much for joining us tonight.